All right, guys, welcome to episode 5. Today we are talking about dividend and growth investing. Now, before the video starts, make sure to use our affiliate links for Robinhood and Acorns. If you click them and join, you'll get either a free stock or $5. Free stock for Robinhood, $5 if you join on Acorns. Subscribe, drop a comment, turn on notifications, and let's get this started. So I'm going to be talking about growth investing, and Tony's going to be talking about dividend investing. Now, there are two opposites when it comes to strategies. So growth investing is pretty much exactly how it sounds. You are trying to grow your portfolio by investing in stocks that have an above average return. So, for example, Tesla just exploded recently. That would be considered a growth stock. That stock went absolutely insane, and that they also don't pay a dividend, I don't think. So growth stocks typically don't pay dividends.
Yeah.
So the reason this is because instead of paying you the shareholder dividends, they're taking that money and they're putting it directly back into their company, which allows them to make more money and grow their company, basically. As opposed to dividend investing is the opposite, but I'll let Tony cover that.
Right.
So, yeah, growth investors pretty much, you're treating, if you get a dividend, it's going to be very low. You're just treating it as an added benefit. You don't really care at all. You're basically just trying to grow and get the biggest return possible. So basically, there's growth ETFs. So these ETFs will be something such as QQQ is a growth ETF. I think it's in technology.
SPYG. Pretty much all growth ETFs are heavy in tech because we
Yeah.
had such a booming year for tech because of the pandemic. But two that you should look at that we both have are QQQ and SPYG. Two good growth index funds, or ETFs, I should say. Lower expense ratios and have excellent return rates over the last 5 years.
Yep. And I think that's pretty much it for growth investing, unless you can think of anything else.
No, I would say this video is not really about dividend versus growth. I think it's good we both think it's good to have a mix of both. We're just telling you the difference of them.
Yeah.
So let's get into dividend investing. This is something I kind of like more than Andrew. Dividend investing is a strategy of buying stocks that pay dividends in order to receive a regular income from your investments. So the income that you're getting paid out is actually in addition to the growth of the stock that you hold too. So dividends are payments a company makes out to shareholders simply just for owning a share of the company, right? Dividend reinvestment program is the most effective way of gaining compound interest and building up a steady stream of income at the same time. It's perfect for retirees. If you have 200 grand invested at an average 3% dividend yield, you're going to get about $6,000 a year. It's a nice little added income to your 401k or your Social Security payments or whatever else you may have. Now, the three types of dividends that you're going to have as far as taxes, you're going to have qualified incomes, you're going to have long-term, you're going to have qualified income and ordinary income are two. And qualified income, what that means is that your ETF or your company is eligible for a long-term capital gains tax break. So if you hold a stock or an ETF for over a year, you're now eligible for a long-term capital gains tax rate. So instead of paying 20%, you pay 15%. Usually it's a 5% knockdown based on your tax bracket. So ordinary income is real estate typically, or MLPs, which we're not going to cover today. So nobody really owns them. Or if you're a beginner, you're not really going to be buying MLPs.
Yeah. So go ahead.
So real estate, typically you're going to have lower overall returns, but they're excellent for dividend and fixed income. A lot of dividend investors buy REITs.
Yeah. So all real estate investment, it stands for real estate investment trusts, but all REITs, they're taxed at whatever your income tax is. So if you are making $1 million a year and you're getting taxed 50%, that's exactly what your dividend REIT tax is going to be, 50%.
So the good thing about REITs, though, is even though you're going to pay a higher tax, they pay higher dividend yields. And it's a government law. The last I looked, we'll throw this on the screen to verify, 90% of REITs income has to go back to investors.
Yeah, that's true. That's true.
Right. So if they make a lot of money and 1 year it's a booming year, you're going to be reaping the benefits of that as a dividend investor.
Yeah, so because of this, you won't really see the REIT price go up because they're paying out 90% of their income to you. So.
Yeah, there are some that do pretty well, but for the most part, if you're buying REITs, you're going to be buying them for dividends, for fixed income. So we covered that. We're going to cover tax advantage retirement accounts. So typically, if you're an income investor, you're going to want to buy your dividend stocks in a tax advantage account, an IRA, 401k, a Roth IRA, because you're going to be subject to far less tax, or you may not get taxed at all. So investing in companies with healthy dividends of around 2 to 5% is the way to go. You're going to want to stay away from really high yielding companies that pay you a 10% yield, because it's not sustainable.
Besides REITs are pretty high.
Yeah. A very good REIT is actually ticker symbol O. It's Realty Income. They own Walgreens, CVS, a lot of really highly reputable companies, and they pay I want to say a 4.5% dividend yield, which is very healthy, very safe, and it's sustainable. So look for companies like that. If you don't want to buy individual companies, you can buy an index fund or an ETF. An excellent ETF to look at is VYM and SCHD. They're both high dividend and they're both pretty good growth. So you get a good combination of both. They're both around.
I own both of those.
Yeah, I do as well. Look into them. VYM, SCHD. They both pay about a 3.5% dividend yield. So if you have $100 invested, you're going to get about $3.50 a year, which is pretty good. And VYM's about a 37% return rate over 5 years, and SCHD is about a 65%. So they're both excellent growth and excellent dividend yield, and super safe, super reliable. And I think the final take is buy a mix of dividend and growth and be diverse,
Yep. Typically also, you're not going to want to hold growth stocks for a long period of time. You wouldn't want you wouldn't want QQQ in your 60s or 70s, really. You would want to be more strained towards bonds and high dividend paying ETFs or stocks, but yeah.
Yeah, and I will say the VYM and SCHD are made up of a lot of dividend kings, which means they've paid their dividends on time every year with growth for 50 years. And then there's the, I forget what the other dividend club is, but it's where if they pay for 25 years consistently without any cuts and increase.
Yeah.
I'll have to throw the name up on the screen.
I know what you're talking about. So yeah, there's dividend safety ratings basically. So if a company continually pays out their dividend and they don't lower it or they don't stop paying it, there's a website that has dividend safety ratings. So you want to look for a high dividend safety rating, and that's basically how you pick your dividend ETFs or your dividend stocks or ETFs.
Do your research. Don't just watch this channel and buy exactly what we say, even though we feel good about it. Research what we're telling you to buy and make sure you feel good about it before you take someone else's word. So that's my final take.
Yep. So. Yep. That pretty much wraps it up. Just make sure you know what you're buying, like Tony said. And yeah, don't forget to subscribe. Our links are in the description, and that's it, guys. Peace out.